Welcome to the Deep Dive. We're here to quickly unpack complex topics, giving you the essential insights without you getting lost in the weeds. Today, we're jumping into the Q1 FY26 results for Alok Industries Ltd. That's for the quarter ending June 30, 2025. So our sources, we've got the official financial filings right here, the ones submitted to the exchanges. Plus, we have a set of questions ready to make sure we hit all the key points. Our goal really is to pull out the most crucial information, maybe some surprising facts for you, and make sure nothing vital gets overlooked.
Exactly. And, these financial reports, they can look pretty intimidating at first glance. Dense numbers, footnotes. But if you focus on what really matters, the core insights, you get a much, much richer picture than just reading the headlines. It's about understanding the why behind the what.
Okay, let's unpack this then, diving straight into those top-line numbers for Q1 ending June 30, 2025. What are the immediate highlights? What really jumps out from Alok's results? Both standalone and consolidated.
Right. Looking directly at the statements, the key figures are pretty clear. Standalone revenue from operations, just the main company, came in at Rs 884.52 crore. Then you've got the consolidated revenue that includes their subsidiaries and JVs. That was higher at Rs 932.49 crore. Gives you the bigger group view.
Okay, so that's the top line. What about the bottom line?
Well, that's where we see the losses. Standalone net loss for the period was Rs 176.48 crore, and the consolidated net loss was slightly less at Rs 171.56 crore.
And the earnings per share?
Yeah, reflecting those losses, the standalone EPS was negative Rs 0.36, and consolidated EPS was negative Rs 0.35.
So, okay, clear net loss, but I also noticed a positive EBITDA figure mentioned. That seems, well, contradictory, doesn't it? It kind of suggests the core day-to-day business might be okay, but maybe other things are dragging the net result down. What does that tell you about operational health?
Yeah, that's a really crucial distinction, and you've hit on it. They reported a positive EBITDA of Rs 42.86 crore for the quarter. And that is significant. It means basically that before you account for interest, taxes, depreciation, amortization, the core operations are actually generating cash.
So the engine's running, essentially.
The engine is running, yes, even if the overall company is carrying a heavy load from the past, and that load is, well, it's huge. We're talking accumulated losses of Rs 23,044.88 crore as of June 30th, 2025. That's staggering. 23,000 crore reflects some deep historical issues.
Wow, 22,000 crore. That's hard to even wrap your head around.
It is. But on a slightly more positive note for their immediate situation, their current assets do exceed their current liabilities. The difference is about Rs 177.77 crore, so there's some short-term liquidity buffer.
Right, so you have this massive historical loss burden, but positive operational cash flow via EBITDA and net current assets. It's a real mix. How should you, as someone trying to understand this, balance these signals? And what's management saying about their own confidence?
Well, this is where you look for signals like the going concern basis. Despite those huge accumulated losses, management prepared these financials assuming the company will continue operating. That's a formal accounting principle, but it's also a strong signal of management's belief in the company's future viability. It tells you they think they can navigate this.
Okay, that's helpful context. So we've got the main numbers, the EBITDA distinction, the going concern note, but often the really interesting bits are hidden in the notes, right? Any major one-off events or specific accounting items that really shaped these Q1 results?
Absolutely. You always need to dig into the notes. First off, just context. The whole group operates pretty much in one segment, textiles. And the consolidated view includes those 8 subsidiaries and 2 JVs we mentioned. But the really interesting part this quarter, exceptional items, specifically related to that tornado incident back on July 12, 2024.
Ah, yes, the one that hit their spinning plants in Silvassa. I remember that.
Exactly. That caused an initial assessed loss of about Rs 61.42 crore. The company filed an insurance claim, naturally. They'd already got some money back by March, about 55 crore. But in this quarter, Q1 FY26, they received another Rs 25 crore from the insurance company. Plus, they sold off some of the damaged assets for about Rs 7.02 crore.
Okay, so more insurance money plus asset sales.
Right. So, netting it all out, they recognize an exceptional gain this quarter related to that incident, amounting to Rs 25.60 crore.
Interesting. So an unforeseen event, a natural disaster, actually results in a positive exceptional item in this quarter's P&L because of the insurance payout timing and asset sales.
Precisely. It's a good reminder for you, the listener, that financial statements reflect these real-world events and how companies manage them. Shows a bit of resilience in handling that recovery process.
Definitely a surprising fact buried in the notes. Now, moving on to the auditors. They gave an unmodified opinion, which sounds good, but then they specifically drew attention to one particular note. What was that about, and why is it significant? What's the underlying message there?
Yes, the auditors, SR, BC, and CO LLP, gave what's often called a clean opinion unmodified. That's positive. But, and this is fascinating, they included an emphasis of matter paragraph, pointing specifically to Note 4 in the financial statements. It doesn't change their opinion, but it flagged something important for you to consider.
Okay, so what's in Note 4?
Note 4 deals with the accounting for a very, very large chunk of debt. This goes back to the resolution plan approved by the NCLT, the National Company Law Tribunal, back in March 2019. This was part of the insolvency resolution process. Under that plan, a massive amount of debt, Rs 17,384.02 crore, was assigned to the resolution applicants. That's the entity that took over, essentially.
17,000 crore, that's huge.
It is, and here's the critical part. That specific debt does not carry any interest for the first 8 years from the closing date of that plan. 8 years interest-free.
Wow, okay. And how are they accounting for it? That's the auditor's point.
Exactly. The company is accounting for this huge non-interest-bearing debt at cost, just the face value. Now, this actually overrides the normal Indian accounting standards, IND AS. Usually, IND AS would require such a long-term interest-free liability to be recognized at its fair value.
Meaning, they'd have to estimate its present value, which would be lower than the face value.
Correct. And then they'd have to recognize an imputed interest cost over the 8 years, gradually increasing the liability back towards the face value.
So by accounting for it at cost, they're essentially not showing that imputed interest expense in their P&L.
Precisely. They're following the specific direction from the NCLT resolution plan, which overrides the standard accounting rules in this specific instance.
So what's the takeaway for us?
The takeaway for you is that this unique situation, stemming from that past insolvency resolution, significantly affects how Alok's debt burden appears on its books compared to other companies following standard IND AS. It means their reported interest expense is lower than it might otherwise be under standard accounting. It's crucial context for understanding their profitability and comparing them to peers. You have to ask, how does this affect your view of their true leverage over time?
That's a really critical nuance born from a complex legal and financial history. It absolutely changes how you interpret the numbers. So what a journey we've taken through just one quarter's results for Alok Industries. From the headline losses
To that positive operational signal from EBITDA.
the unexpected financial impact of recovering from a tornado.
And finishing with this really deep, fundamental point about how a massive historical debt is accounted for thanks to that NCLT plan.
It definitely shows there's so much more beneath the surface numbers.
Absolutely. It just reinforces why you always need to look beyond the headlines. Dig into those disclosures, read what the auditors are flagging. That's where you find the real insights into a company's financial health and, importantly, its future prospects.
Okay, so wrapping this up and connecting it all. Alok Industries has this complex history, these current results showing big losses but also positive operational cash flow, and this very unique debt accounting situation. Thinking about all that, here's a final thought for you, the listener, to consider. If you were tracking Alok Industries, trying to gauge if they're genuinely on a path to a sustainable turnaround, what specific factors or metrics would you watch most closely in the coming quarters? What would be your key indicators?